Hello and welcome everyone for another weekly analysis covering the macro and crypto markets. Starting off with the monetary policy, we see that Trump is firing Fed board member Lisa Cook, and this signals potential political interference in monetary policy decisions, threatening Fed independence and likely pushing rates higher until institution stability is restored. As you know, the Federal Reserve is supposed to be independent from political pressure, and right now the Trump administration is trying to push as much as they can in order for them to lower interest rates. Why they need to do that? Because they want to roll over their debt. And initially, the plan before the election was for Trump to lower long end of the curve yields. And what do I mean by that? They wanted to lower the yields or the interest rates on the long duration bonds or long duration government debt. And that is the 10-year, 20 years, and 30 years. However, due to all the excessive spending and the fact that Doge failed and they are no longer able to cut government spending, yields on long duration debt stayed high. And for that reason, the only solution for the Trump administration to be able to lower or to be able to roll over their debt is to use the short end of the curve, and that is the less than 1 year maturing debt and up to 2 years or potentially 5 years as well. But in order for them to be able to do so, they need the federal funds rate to go down, as the Federal Reserve can somewhat control the short end of the curve but not the long end of the curve. The long end of the curve is controlled by the market and market participants. So Trump administration, by making this move, is trying to take control of the Fed independence and try to push for a vote to lower interest rates. And obviously, this is creating instability in the Federal Reserve institution, and it's no longer independent. And for that reason, this might create a yield risk. So yields might spike due to the moves that the Trump is trying to do, specifically the long end of the curve. On top of that, the recent dovish Fed commentary at Jackson Hole appears driven by two factors: either anticipated weak jobs data, as was mentioned by Jerome Powell, and also mounting political pressure from the administration. Personally, I tend to believe that the dovish comments that were made by the Federal Reserve or by Jerome Powell was mainly due to increased political pressure on the institution. And we're going to be seeing during today's assessment that the US economy is somewhat still doing well. The labor market is still okay, even though we have a revision down in job openings. Nevertheless, the unemployment rate is still at historical lows, and initial jobless claims is still holding well. Also, we're going to see that GDP has been revised higher. So the economy is doing well, and the labor market is holding for now. So we don't have increased layoffs. We don't have unemployment rising. So why is the Fed actually cutting in a strong economy where inflation is still above their 2% target? So obviously here, the most likely reason is a lot of political pressure coming to the institution. When it comes to financial market dynamics, we see that the VIX is in decline right now. So the volatility index for equities in decline, and equity strength since April the 2nd reflects significant policy intervention to support markets artificially. Since April 2nd, where the Trump administration launched all the tariffs and the fact that they would like to fund the government using tariffs and also fix the whole situation of trade deficits, we saw a lot of volatility come back to the market and a lot of selling across the board. However, this prompted the Trump administration to have a Trump put, if you want, where they will not allow the equity market to fall more than a certain number, if you want, or a certain ratio. And we've seen multiple intervention by the Trump administration to calm the market whenever there is any signs of panic or selling, for that matter. And we see here that the volatility index is falling. Volatility is becoming less and less each day, and this is obviously creating room for the equities market to go higher. If we look here at the equity index, and this is the S&P 500, we see that we actually on 28 August did put in an all-time high on the index of around $6,490. The traditional finance is somewhat doing well. So the primary threat right now remains the bear steepener, and that is the difference between the 10-year to 2-year yield curve, which appears posed to break out, creating bearish conditions for asset prices. So first of all, let me open the picture of the bear steepener so you guys can follow with me on what I'm talking about here. So this is the difference between the 10-year and the 2-year yield curve. Usually, the normal yield curve is you have lower rates on the short end of the curve and higher rates on the long end of the curve. And it is logical, because if you are lending your money to the government and you're lending it for, let's say, less than 1 year, you would get, let's say, 3%. And if you are lending to the government for 10 years plus, then you will obviously request a higher risk premium, therefore a higher yield, because you're giving all that money to the government for a very long period of time, and you don't know what will happen and what inflation will be between now and 10 years. Logically speaking, the long end of the curve is supposed to have higher yields than the short end of the curve. However, when we have an inversion of the yield curve, this means that there's something happening in the economy that's not okay. And what I mean by inversion, I mean that the short end of the curve yields and interest rates are higher than the long end of the curve, effectively inverting the yield curve. Once there is something risky in the economy and there is warning signals flashing, then the yield curve inverts. So for that to come back to normal, for the yield curve to go back to normal, there is two kind of scenarios that can happen. Either something called a bull steepener or a bear steepener. A bear steepener is where the long end of the curve and the yields on the long duration go high or faster than the short end of the curve, and eventually you will end up with long duration yields higher than short duration yields, and this is called bear steepener because yields are rising and therefore they will create a headwind for asset prices and equities. And then the second scenario is a bull steepener where the short end of the curve actually falls down below the long end of the curve, and this is usually positive for liquidity and for asset prices in general. So what we see here in this image that I have in front of me is the 10-year to 2-year. Right now it is very close to breaking out, meaning that the long end of the curve is catching up to the short end of the curve, effectively meaning that the yield on the long duration bonds is rising, which is definitely something negative and creates headwind for equities in the market. This is a very risky signal in the credit market that we should keep on our radar, because if long duration bond yields keeps on rising, at a certain point they will put a lot of pressure on equity prices across the board. Volatility also is expected to spike in September as traditional finance return from summer vacation periods and they rebalance their portfolios, basically selling their stocks that made good returns and then rebalancing their portfolios. And we're expecting in September for volatility to spike up again and create a bit of a selling pressure. On the other hand, we also see that gold is also testing all-time highs again, signaling underlying market concern and loss of faith in fiat, and at the same time continuation of the de-dollarization trend. So we see here a post by Kobesi letter mentioning that gold is replacing fiat currencies as reserve currency. Gold's share of global international reserves rose 3 percentage points in Q1 2025 to 24%, the highest in 30 years. Again, we also have another post mentioning that foreign central banks now own more gold than US treasuries for the first time in almost 30 years, further telling us that there is a move away from the dollar. So this can be interpreted in two ways. Either gold strength is perceived to be due to global instability rising, which will be bearish for crypto as digital assets are still perceived to be risk-on investment asset class. And the second one is if gold is breaking out because of perceived future inflation, then logically speaking, this should be positive for Bitcoin, but obviously at a later stage, not now. Because as we've seen, whenever gold is breaking out, Bitcoin tends to chop sideways. And once gold starts consolidating, this is where we see BTC rip higher in order for it to catch up to gold. Personally, I do believe that gold is moving higher because markets are right now perceiving rate cuts happening in September and onwards. And when rate cuts are happening due to political pressure rather than weakness in the economy, then inflation is gonna follow. And obviously gold and Bitcoin sniffs inflation very quickly, and this is one of the reasons why gold is breaking out. So this is what this precious metal right now is telling us. When it comes to economic indicators, we see that the US economy is showing resilience. The second revision of the GDP, which came in last week, was revised upward by 0.3%, and also initial jobless claims are declining. They dropped from 234 to 229,000, and also inflation is somewhat stable with a slight uptick in July. The PCE numbers came in also last week. This is telling us that inflation is sticky and inflation is higher than the target of the Federal Reserve of 2%. Keeps on making us wonder, why is the Federal Reserve cutting rates when you have a strong economy? GDP got revised higher to 3.3 and the job market is showing some signs of weaknesses by the revision of the job openings data, but as we can see in initial jobless claims, we did not see an uptick in initial jobless claims. Moving on to the trade and geopolitical tensions, we see that the tariffs discussions are providing some market stability, with further settlement likely to drive markets higher as growth expectations improve. So we see that the euro is proposing to remove the US tariffs this week to meet Trump demand. So obviously it looks like the trade agreements between the euro and the eurozone and the US is somewhat coming to a full-on agreement, and obviously this is creating more stability in financial markets, which is perceived to have a higher growth expectation. All of this is being repriced in equities. A potential also US-China trade agreement would be highly bullish for global equities. However, tariff implementations remain chaotic. Despite the stability that we're seeing between the Eurozone and the US, nevertheless, tariff implementation, especially between East and the US, is still very chaotic. We see that there is a new 50% tariff being imposed by Trump on India, and this is basically related to Russian oil purchases. On top of that, there is threats being made to China over rare earth magnet exports. Even though we have some stability in tariffs, we are not out of the woods yet. The tariff and trade deals are still creating macro risk for financial markets that we have to keep on our radar while we are positioning our portfolios to whatever might be coming. So if we look at the Bitcoin chart, and right now we are hovering at the bull market support band. So this could be a very good bottoming signal here. However, if we break below this, then the next level would be falling to the 50-week moving average. So that's the one here. So this is represented by the blue line that you see here, and it's currently sitting at around 95K. So if you look at this 50-week moving average, you see that it has been a great indicator of a potential bottom for or local bottom in bull markets. Since this bull market started, we've tested it multiple times here in August 2024, in the summer of 2024, and in April 2025, and right now we are still above it. But this line is currently around 95, 96K, and it could act as a very good indicator of where BTC might be falling in the event where we continue doing this sharp sideways action that we're seeing right now. The volume on the monthly chart is, as you can see, is falling, which is not a good sign. If I look at another chart, which has more history, we can clearly see that every single time this flashed, it definitely wasn't a good sign. So we see it flashing one time here in 2013, where we had a very pullback before we resumed our uptrend. There was a pullback of around 57%, which was definitely major. Then in the top of the 2014, we see that timed very well the months where we basically rolled over into a bear market. The same can be said also here in the cycle of 2018. This one in 2020 was a false positive, as you can see. The signal did show a warning. However, we went on a parabolic move before the cycle ended, and again we see that there was a sign here and also here. This is a cluster, and this is where we entered into a bear market. So this time around, we also see that the signal on the month of August, which is why when I started this call, I was mentioning that there are some early signs of a potential topping for this cycle. On top of that, I've also read a post made by Bob Lucas. For the people that don't know who Bob is, he's an amazing trader. And he also mentioned that either we have topped here or we are about to enter the last phase of the cycle, where basically you have all the FOMO and euphoria before topping over and then falling down. And everybody's anticipating this to happen somewhere in October, November, potentially December. And that's why we're going to be increasing our hedging position. One of the strategies that I will be following for the Freedom Capital portfolio is that instead of selling all of my BTC at the absolute top, I'm going to be selling some of my BTC and rolling all of that profit into a big hedging position. In case the market cycle tops and we go down, then I have the freedom, or I have the right to sell my BTC at whatever strike price I hedge with. So obviously, once this happens, I will be definitely letting you know. But we have to be very. We can also see in the dominance chart that Ethereum is also holding well above the cloud, while BTC is deeply below the cloud. So Ethereum right now is being bid, and Ethereum is driving the market forward. We see that Tether recently launched a USDT on RGB protocol, which is a layer 2 for Bitcoin. And this is to expand native Bitcoin stablecoin support, potentially increasing Bitcoin network liquidity. So obviously this is extremely bullish for Bitcoin, because we need more liquidity and more stablecoin available inside of BTC in order for Bitcoin to move from store of value into medium of exchange. Moving on to the political and regulatory environment, we see that the Trump public statement that the traditional financial system is broken and crypto will fix it provides strong political tailwind as well. I'm not going to be playing this video. It's available in the show notes, so feel free to listen to it. This is extremely bullish. He's basically talking about the fact that the current financial system infrastructure is outdated. The data comes in very late, and they are planning to upgrade all of this using state-of-the-art crypto technology, as Trump mentioned it in his. On top of that, we also see that the CFTC regulatory approval allowing US citizens to trade on Binance and other foreign exchanges will drive additional capital inflows into the asset class in general. So the overall US regulatory environment continues moving in a favorable direction, supporting cycle continuation thesis. On the other hand, we also have Google planning to launch their own layer 1 blockchain, potentially competing with established public chains for market. So this development could redistribute value among existing layer 1 protocols as big tech enters the space directly. Hedging at the moment is no longer optional, it is a must. And for that reason, we will be adding more hedges to our positions. Finishing off with the altcoin season. So altcoin season is currently at 61, further closer to altcoin season than BTC season. But be very careful with this indicator, because it is a lagging indicator. This is very much lagging, and the current market setup is very risky for altcoins, specifically medium to low cap coins. So yes, there are certain coins that are outperforming BTC over the past 90 days, but this doesn't mean that the future will remain the same. So finishing off with the bull market peak indicators, we see that we are at 100% hold, meaning that most of the indicators that tells us that we are in a bull market nearing a top are not flashing any warning signals.